Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today is Ashwini Agarwal of Demeter. He needs no introduction. Ashwini, great having you. Thanks for taking the time out.
Thank you, Niraj. Thank you for having me here.
The pleasure is ours. Ashwini, if I'm not wrong, having just heard you over the last 1.5 months on different platforms as well, you were probably not as constructive on the markets. They've largely consolidated with the mid caps and small caps doing the bulk of the work. Now that they have rallied as well, what is your stance currently on Indian equities by and large?
Niraj, we are in the middle of a full-blown bull market. And in bull market, what happens is that risk appetites increase. Sometimes they increase to a level that people cannot digest financially, but they continue playing the game because it just seems too attractive to let up. What we are seeing in the mid and small cap is something similar. So let there be no doubt that we are in a full-blown bull market, and this is when mistakes happen because investors take risks they don't understand, and sometimes the risks are greater than their ability to bear the financial consequences of it. In the mid and small cap, there are pockets of extreme overvaluation. There is euphoria in select spaces. So in many ways, it feels like maybe the middle of 1994 or the latter part of 99, and dare I say 2007. Now, why do I bring up those periods? I bring up those periods because one has had the good fortune to live through those bull markets, but also that we have an inability to mark the top of a bull market. I mean, if I said that IT was expensive in December 99, I would have been right, except that I would have been wrong by about 100%. So what I'm saying is that this bull market can carry on, but we are already in a frothy territory, and anybody who sold IT in December 99 probably looked bad for 3 months, but probably looked very good from a 2-year perspective. So just bear that in mind. Take money off where valuations are extreme, and we are discounting 27, 28, 29 earnings, things like that. So if we do that, we should be fine. But overall, I think the interesting part is that mid and the large caps have not done much. They've been consolidating. The Q1 earnings season was by and large pretty decent, and the macro environment in India looks fine. So barring the fact that some risk off might emerge globally as global markets roll over, oil prices go up, interest rates continue to remain high for longer, and these are all factors that can lead to a global risk off. I don't see a major sell down in the large caps, maybe 5-10%, who knows? But that's where I am. So it's kind of a very confusing picture that I'm presenting. But if you sift through what I've said, I think I'm trying to make it as clear as possible.
Okay. Playing the devil's advocate, Ashwini, most people will say that where the valuations seem extended, bhai wahan pe growth hai. Companies are talking about some fairly strong growth, FY24, 25, maybe even 26. The plans look robust. So how do you square the circle in that such a scenario?
See, Niraj, what happens is the further out into the future you're willing to discount, the more likelihood of going wrong. We saw the same arguments being presented for some of the new tech-enabled companies that listed in 2021, and we saw what happened. We saw the same arguments being presented for the IT services companies in the start of 2000. And they did correct for quite a bit. So I'm not disputing that these are good businesses and they'll grow for the next 10, 15, 20 years. All I'm saying is, what are you paying upfront for it? The further out into the future you discount, the more risk you're taking, the more uncertainty you're dealing with. And that is the real issue in my mind. I don't think there's anything wrong with buying these stocks if you're willing to hold them for the next 10 years. You'll make money. But what is the point of holding a small mid-cap stock for the next 10 years for a pedestrian return of 14 or 15%? It doesn't make sense. It doesn't compensate you for the risk. That's the point that I'm trying to make.
Valid point. When I sift through what is actually done well, Ashwini, in the, let's say, since March, when the rally actually started, we've had defense, we've had railways. To an extent, we've had some mid-sized pockets in construction, infra, real estate, and cap goods, largely forming the bulk of the move. In some sense, farmers also participated now, but we can argue that pharma is not overvalued. If anything, it is probably still undervalued.
Yeah.
So, are you recommending that those favorites of the market currently are where in some pockets there could be valuation discomfort and there might be merit in trying to take some money off the table?
Absolutely. That's exactly what I'm saying. So I don't think the whole market is overvalued. The whole market is never overvalued. I mean, if you go back to 2007, if you, the height of the market, if you had bought pharma or if you had bought consumer staples, or if you had bought IT services, you would have done very well with a 3-year horizon, right? So it's just that back then, if you had bought construction companies or real estate companies or infrastructure plays or power plays, you would have lost a bucket load of money. Similarly, in 2000, at the peak of the market, if you had gone and bought a cement company or gone and bought a financial or even a PSU bank, you would have made loads of money with a 2 or 3 year perspective. So there will always be pockets of overvaluation and pockets of undervaluation in a market, and there are pockets of overvaluation, and that is exactly what I'm worried about. That's where significant drawdown is possible, because again, please remember that in defense and in railways, where there is so much euphoria, your principal customer is the government. Now, history tells us that where government is the principal customer, there can be delays, there can be disputes, there can be cash flow issues. I mean, these have been there, in the past, and they will be there in the future. I don't think that the government's way of doing business has significantly changed. Yes, it has improved at the margin. I'll grant you that. But there is a certain way in which the government bodies are forced to conduct themselves because of vigilance and because of other issues that they have to deal with, and therefore to say that all plans will get done in the manner that they are envisaged today, I think is a bit of a stretch.
Fair point. Very, very fair point. Ashwini, you, by virtue of the fact that you run a private portfolio, are not necessarily mandated to stay close to the index in any fashion whatsoever. So you would have a lot of bottom-up ideas, and I understand that. But can you give us a flavor of where is it that you might be the highest overweight on thematically, considering what you just told us?
Yes. So, see, financials continues to be a reasonable part of the portfolio. It's underperformed in pockets, especially the large private sector banks over the last 2 years or 3 years. And that's disappointing because the macro environment for growth is extremely positive there. So overall financials, where the PSUs have done well, some of the bottom-up stories have done phenomenally well. But the large frontliners have disappointed. But as a basket, I would say that the business environment is very, very constructive, and valuations are still reasonable from an expansion of ROE perspective, because ROEs are expanding for pretty much every player out there. So that's one area. The other, which you spoke about in your opening comments, is pharmaceuticals. If you recall, in the past, we've spoken that this is one area which has been underperforming over the last 3 or 4 years basis, and I see some green shoots there, especially with the level of underpricing in the US having reached an extreme, and drug shortages becoming very high. So, and that has started to play itself out, and especially there, you have other two cost drivers as well, with raw material prices stabilizing and with shipping costs normalizing. So that's another area of interest to me. The third one I would say is downstream chemicals. Downstream chemicals, because again, in downstream chemicals, what you saw over the last 2 or 3 years was hyperinflation in the raw material costs because of transportation bottlenecks, the extended lockdown in China, and so on. And those factors have also now gone away. and raw material pricing environment has become reasonably benign. Here, I think the only remaining headwind is that the global demand is starting to soften again. So if you are a commodity exporter of a bulk drug or of a chemical that's sold in large quantities, while your costs have moderated, so have your end prices. So your margins have normalized, and that's something great. But volume growth might be a little tepid. So this is a little bit of an area where you have to be very, very careful about what you pick and what you back. In addition to that, there are several bottom-up ideas which still look interesting to me. They are in all odds and ends of the market from an industry distribution perspective. Some of them have a domestic manufacturing footprint. Some of them have a services business. So it's all over the place, but it's very bottom-up. But there are plenty of opportunities in the market if you want to look away from a few areas that have done phenomenally well.
Got it. Ashwini, one final question is, what worries you, aside of course, the headline valuations? Is the nature of worry more global in nature as to what could happen to the inflation print because of the coming winter and crude and so on and so forth? And there have been some moves there. Or is it more domestic in nature in that there could be a risk of sentiment coming closer to the elections? And what if the state election results don't quite go as per what the market expects them to?
So, Neeraj, all the points that you mentioned are, risk factors. All of them appear to be reasonably benign right now. But again, what history tells us is that, things change, and market sentiments are often driven by small changes initially, and then they kind of snowball into a much bigger sentiment effect. So I can't say with certainty which of these factors will play itself out, but I think all of these are very valid risks. I think a lot of people have been scratching their heads as to why the U.S. market is so positive, despite the fact that interest rates are going to likely stay higher for longer, and the economy is bound to slow down. We are also worried about slower exports and slower imports in India, which has to feed through to domestic growth, not to mention the El Nino effect, which seems to be playing out, and what that does to rural demand. And then you have elections and so on and so forth. So I think all of these are very valid factors. I can't pinpoint and say which one of them will cause the market to become nervous, but I think some of them will. Having said this, there's another very interesting factor that can play itself out. See, what's driven the market over the last 2 months in particular is significant amount of foreign inflow. And there, I think, India is a little bit of a one-eyed king in the land of the blind. So if some of the other markets start to look interesting in the emerging markets universe, where valuations are actually very attractive, then you might see the foreign flows into India starting to slow down. I mean, I don't see large outflows happening right away, but I think some inflows might come up. So that can be another additional factor. And last but not the least, I think the paper supply has started to resume itself once again. As the markets have turned higher, you are seeing large block deals by promoters, by private equity guys, and so on and so forth. So at some point, I think that may also play itself. But I think the supply of paper right now is still fairly small relative to the incremental inflows from within India, even if we were to ignore foreign investors. So I don't know how big the last factor will be.
Lovely talking to you today, and thanks for putting so many pieces into perspective in this short conversation, Ashwini. Much appreciate your time.
You're welcome, Niraj. Have a nice day.
You too. And viewers, thanks for tuning in to this edition of The Talking Point.